Hello everyone, I'm Burton Malkiel. If you clicked on this video, I bet there is an 80% chance you re-here with one question. Why do I always win small and lose big in the stock market? Look, you might have heard your friend, your neighbor, or maybe some guru in a sharp suit yelling on TV that a certain stock is about to jump tenfold. You got excited, you followed suit, and you bought in. Maybe you actually made a little money. That feeling was intoxicating, wasn't it? Winning. You got a taste for it and started trading frequently, chasing those hot concept stocks. And what was the result? You gave back all your profits, plus transaction costs and taxes, and now you're sitting in front of your computer, staring at your account numbers, scratching your head, wondering, what the heck happened? Don't be fooled. I've seen this play out thousands of times. This isn't a problem with your intelligence. It's a problem with your method. Let me be direct. You are not investing. You are gambling, and you're playing a game with terrible odds. Today, I'm going to give you a lesson. This lesson won't teach you how to pick the next apple. It will teach you how to consistently, steadily, and gracefully generate wealth in a place, Wall Street, that is full of temptation and traps. I call them the firm foundation theory and the castle-linear theory. The firm foundation theory. This is the traditional method I endorse. It argues that a stock's value comes from concrete things, its future earnings, dividends, and assets. The investor should act like a real estate buyer, calculating the cost of the land, steel, and concrete, then looking for assets priced below that intrinsic value. The castle-linear theory. This is the mistake you often make. You're not evaluating the company's value. You're re-guessing what price the next greater fall will be willing to pay you for it. You're not buying a foundation. You're buying a castle built on clouds, devoid of substance, supported entirely by market emotions, news headlines, and blind optimism on social media. When the market is in a frenzy, this air castle might make you feel like a genius. But remember, emotions fade. When the first panicked investor starts selling, that castle will pop like a balloon, and you'll find that the high price you paid has only bought you a handful of rubble. So, if you want to generate consistent, stable returns, you must first break this bite for the next sucker speculative impulse. Now, let's discuss the central concept of my life's work, the efficient market hypothesis, EMH. This theory sounds academic, but its conclusion is very simple, and it might frustrate you. Mr. Market is much smarter than you think. Weak form efficiency, past stock price movements are useless for predicting the future. Those so-called technical analysts drawing lines and trying to find patterns are wasting their time. Stock prices follow a random walk. The result of your coin toss last night has absolutely no bearing on the result of your coin toss today. Semi-strong form efficiency. All publicly available information including corporate earnings reports, news, and analyst predictions is digested and reflected in the stock price the second it is released by millions of high-frequency trading algorithms and professional traders who have supercomputers and multi-million-dollar salaries. You can't. This is the harsh reality. The vast majority of actively managed funds consistently fail to beat their benchmark index over the long run. If the professionals can't do it, why should ordinary investors like you and me waste our time and energy trying? Since you can't find undervalued stocks, and you can't successfully time the market, what is the secret to consistent, stable returns? The answer is so simple it's hard to believe. Don't fight the market. Just own it. Index funds. You don't need to be a stock-picking genius. You just need to buy into a low-cost index fund that covers hundreds or thousands of stocks in the market, such as one tracking the S&P 500. By doing this, you buy the entire market, and your performance will align with the growth of the American, and even the global, economy. Costs are your invisible enemy. This is what I must stress. If an actively managed fund charges a 1.5% expense ratio, while an index fund charges only 0.05%, over a 40-year compounding cycle, that 1.45% difference will act like a giant magnet, sucking hundreds of thousands, if not millions, of dollars out of your wealth. Remember, fees are the single greatest obstacle to your investment success. The power of compounding. Einstein called compounding the eighth wonder of the world. Your goal isn't to make 50% in the first year. It's to make a stable 7 to 10% every year for 40 years. Time and compounding are your only magic tricks. My investment plan for you has only 3 steps. 1. Start saving as early as possible. This is paramount. 2. Invest those funds into low-cost, broadly diversified index funds. 3. Close your eyes, lock your computer, and go live your life. Liberate your energy, time, and mental effort from tracking volatile stock quotes. The real risk on Wall Street is not that you might lose money, but that you might waste your most valuable asset, your time. Every minute you spend chasing those hot stocks is a minute you could have spent with family, learning a new skill, or simply enjoying life. The purpose of investing has never been to turn you into an anxious gambler. It is to build a firm foundation for your life. This foundation allows you to weather any storm and confidently plan for your retirement and your children's education. I hope you now understand. You don't need to be smart enough to beat the market. You just need enough patience and discipline to let the market work for you. So, make a wise decision. Start your automatic contributions to your index fund, and then put down your phone. Go live a wonderful life. When you look back a few decades from now, you will thank me for these words today.